What if you didn't have an emergency fund? What if you didn't have enough insurance? What if you didn't have enough savings? What if you had to wait in order to be able to invest? And what if you were just simply deep in debt? But what if I told you that we had the solution for all of those questions? According to a 2013 survey done by CNN Money, 64% of the workforce upon retirement will still be in debt. And 74% of those retirees will have never consulted with a financial planner. But what are you currently doing to get out of debt? Well, if you have a job that allows you to do overtime, that's one way of making money and throwing extra cash to your debt. Perhaps you might have the ability to work at multiple jobs. There's also debt settlement, and there's bankruptcy, which is something we don't want. But what we have is called the MAP. Now, the MAP is an acronym for Money Management Asset Program. MAP can guide you to systematically and effectively pay off all of your debts. And when we say all of your debts, we're talking about your mortgage, credit cards, car loan, plus your student loans. And all of these debts will disappear without you having to use any extra of your own money to do it. But first, let me tell you what the MAP is not. The MAP is not a biweekly program. The MAP does not do loan modification. You don't need to refinance your home. We don't do credit checks. And last but not least, we're not an MLM company. But let me ask a couple of other questions that need to be addressed. Number one, is the MAP legal? And the answer is yes. And the reason why is because everything that is needed to run the MAP is already available to you with your current banking institution. And I love this part. MAP simply revolutionizes the way that you currently manage your finances. Second question, do we have any access to your finances or bank account? And the answer is no. MAP simply allows you to be in complete control of your money at all times. So what's the American dream? Well, for most people, it's to be able to own your home one day. Now, this is a mortgage calculator from Bankrate.com, and we simply put in these numbers that you can do yourself just to make sure that these numbers are accurate. Let's say that that mortgage was $400,000. It was a 30-year term, and the interest rate was 4.5%. When you hit calculate, you'll find out that your mortgage is $2,026.74. That's principal and interest. Now here's that amortization schedule for that same $400,000 loan. And as we put here, here's the first payment. And where does the majority of your payments go for the first 7 years? Well, as you know, the majority of it goes to the bank with interest. So out of $2,026.74, only $526.74 is actually going down to your principal. And $1,500 of that is going to interest. Now, if you were to live in your home for 30 years, you'll find out that you were able to purchase that $400,000 home, but at the tune of having to pay almost $330,000 in interest alone. Let's say that you're in your brand new home and you are about to make your first monthly mortgage payment of $2,026. But let's also say that you had a cash windfall of $7,000. Now, instead of using that money to go on a trip to the Bahamas or buying a big screen TV, let's say that you used that $7,000 and you applied it to your first monthly mortgage payment. So instead of writing a check for $2,026, you're now writing a check for $9,026. The question is, what are the effects to your mortgage loan due to that one-time extra payment to principal? Well, right off the bat, on the very next month, your new principal loan balance from $400,000 is now down to $393 and change. Now remember, the interest after 30 years on a $400,000 loan is $330,000. But because the bank now has to recalculate the interest for $393,000 for the life of the loan, the amount of interest due is only $310,000, which means by making that one-time $7,000 principal-only payment, you were able to save almost $20,000 in future mortgage interest. So here's a question. If people could save $20,000 a month, and all they had to do was add an extra $7,000 in this scenario, why don't they do that every month? Well, the biggest reason is they don't have it. But if it were possible and you could easily afford to make those extra payments to your principal, would you do it? So what you need is a MAP lock, a MAP line of credit. So how do you get a line of credit? Well, you can go to your bank and get a personal loan. You could use a credit card, and we just put here between $5,000 to $15,000. Or perhaps you can borrow from your 401k, a life insurance, or a savings account. Either way, you need to establish a line of credit. Now, I'm going to choose the worst possible way of getting a line of credit, which is the credit card. And the reason why is because of the high interest rate. It could be between 15 to 30%. Aristotle Onassis said, "The secret of success is to know something that nobody else knows." Well, the secret of the MAP is what we do with that line of credit. What does that mean? Well, we want you to treat that line of credit, and in this case we're talking about a credit card, and we want you to treat it like your primary checking account. So, we're going to ask you to pay all of your bills from that line of credit. What does that look like? Well, from your line of credit, you're going to pay for your mortgage, your groceries, your utilities, your car, even your AIG premiums. Everything is coming out from that line of credit. And because you're treating your credit card like your checking account, when you get your salary, we're going to ask you to send your salary back to your line of credit. Let's take a look at some numbers here. Let's say that this family makes $7,000 net income. And the reason why it's $7,000 is, well, they have a $400,000 home. But out of that $7,000 net income, let's say that they were spending $5,500 on monthly living expenses. That's their mortgage, their car, utilities, food, everything. Which then leaves this family with $1,500 discretionary income. Let's say that they have a credit card with $15,000 line of credit. Well, what are you going to do? Well, you have to pay all your monthly living expenses. Your $2,000 mortgage, your $400 car, which comes out to be $5,500. Well, at this point, you recognize that you do have $9,500 still available to you in your line of credit. So what MAP can suggest is that you take another $7,000 from that $9,500 and use that money as a principal-only payment to your mortgage. But at this point, you now owe $12,500 on your credit card. But here comes your salary of $7,000. And where are we asking you to put that $7,000? Back to the credit card as the monthly payment. So if you owed $12,500 on your credit card and you sent your salary of $7,000 back as the monthly payment, at the end of the month, you have an outstanding balance on your credit card of $5,500. So let's review. You started with a credit card balance of $12,500, but after you sent your salary of $7,000 to the credit card company, you ended with a balance of $5,500. At this point, 3 out of 4 amazing things took place. The first one, your $7,000 payment took care of the monthly minimum payment for your credit card. The amazing parts now are your principal loan just got lowered by $7,000. So instead of $400,000, you now have $393,000 to go. You also were able to save $20,000 in future mortgage interest. And the third amazing thing, you know that $7,000 that you borrowed from your credit card that paid down your principal by $7,000 and you saved $20,000 in future mortgage interest? You borrowed that $7,000 from your credit card 100% interest free. So, what would you say if I told you you could own this home in 15 years without you having to personally double your mortgage payments? Would you like that? Well, we can't do that. But what we can do is by using the map, this 30-year, $400,000 mortgage can be paid off in, and we can't do it in 15 years. We can do it in 9.7 years. And we were able to do this without you having to work for those extra monthly payments. So, total interest paid without using the map, $330,000 for a 30-year, $400,000 loan. But the total interest paid using the map is $99,000 because you got your house paid off in 9.7 years, which means that's a savings of over $231,000 that isn't going to the bank simply because you're on the map. And remember, all of this was possible without you having to use any extra of your own money. All those extra payments came from the line of credit. Let's go by a 3-month scenario of being on the map just to show you a little bit more how the map works. We have a $15,000 line of credit, but if you notice at this point there's an asterisk by that $15,000, and the reason why is because the map only requires you to have a line of credit equal to your net income. So this particular family that we're using only makes $7,000, which means if they only make $7,000 net income, the map only needs $7,000 for their line of credit. If you only made $5,000 a month, you would only need $5,000 line of credit. But because this is a complex algorithm, I can't explain to you in layman's terms how to use $7,000 to pay off a $400,000 home. So we're going to use $15,000 just as an example. So you have your credit card, limit is $15,000. What are you going to do with that? Well, you have to pay your monthly living expenses, your $2,000 mortgage, your car, utilities, AIG premium, which comes out to be $5,500. But because the map says you still have $9,500 available, map suggests that you take $7,000 out from your line of credit and you send that amount over to your mortgage company as a principal-only payment. Now remember, when you do that, that $7,000 did two things. It lowered your principal by $7,000 and you saved over $20,000 in future mortgage interest. But now you owe $12,500 on your credit card. But here comes your salary of $7,000. And where are we asking you to put that? That's right, back to your credit card as a monthly payment. So if you owe $12,500 on your credit card and you sent a payment of $7,000, at the end of January, your balance is $5,500. Now, if people are saying, well, I'm going to get charged interest for that, it's true. At 15% for $5,500, your minimum finance charge could be about $150 to $180. But that's not a problem because on that same month, you also saved $20,000 in future mortgage interest. But let's float that $5,500 over from January over to February. Here's your balance from last month. Well, what are you going to do in February? Well, you have to pay all your bills for February, which is another $5,500. But now you owe $11,000 on your credit card. Here comes your salary of $7,000. And where are we asking you to put that? Back to your credit card as the monthly payment. So at the end of February, if you owed $11,000 on your credit card and you paid $7,000, you have a remaining balance of $4,000. Now notice in February, the map didn't ask you to make an extra payment. And the reason why is because the map knows your situation and will never allow you to exhaust your line of credit. So for February, map just said no extra payments anywhere. It's just a simple, ordinary month. So let's float that $4,000 credit card balance over to March. Here's your balance from last month, $4,000. Well, what are you going to do in March? Well, you have to pay all the monthly expenses, which is another $5,500. So now your balance on your credit card is $9,500. Here comes your salary of $7,000. And where does that go? Exactly, back to your line of credit. So at the end of March, your remaining balance on your credit card is $2,500. Now at this point, the MAP is going to send you an email and a text message, and it's going to say, hey, do you know that your balance on your credit card is $2,500? And of course you say, yeah, I know that. And then MAP's going to just say, well, did you know that you actually have $12,500 still available on your line of credit? And what can you do with $12,500? Well, I don't know. How about take an extra $7,000 from that and send it over to your mortgage as another principal-only payment? Because could you not afford $7,000 from that line of credit of $12,500? Absolutely. And the wonderful thing about that was you didn't have to work an extra shift to make that $7,000 payment. So, principal-only payments. In January, you paid $7,000 principal-only payment. And simply 2 months later, in March, you were able to send another $7,000. That means you were able to put $14,000 into your principal. That's $14,000 of equity, your cash. And remember this family who made $7,000 but their discretionary income was $1,500 a month? If that same family decided to use that $1,500 and send it over to their mortgage company as a principal-only payment, and they did it for 3 months, the most that family would have been able to send was $4,500. And yet, on the MAP, same family, same income, same debts, was able to put $14,000 into their principal. Remember how we mentioned that for the first 7 years, the majority of your payments is going to interest? Well, it would take 24 months of traditional payments to put $14,000 into your principal. And the MAP was able to do that in the first 3 months. So here's the amortization schedule between a $400,000 traditional loan versus the MAP. Remember, the banks are hoping that most people will move every 5 to 7 years so that they can get their chunk of the money and you have to start off from the beginning. Well, if you were using the MAP in the first 3 years and you sold your house, you would have $86,000 in equity, which means you could put a nice down payment on your new home and perhaps have a little savings from that. And yet, your next door neighbor who's not on the MAP in 3 years was only able to put $20,000 into their equity. If you were able to stay in your home for 5 years and you sold your house, you would have $170,000 in equity. That would be an amazing down payment for your new home, and you would have a substantial nest egg still left over. And yet, your next door neighbor who's not on the MAP has only put $35,000 into their equity. And finally, if you stayed in your home for 9.7 years, the MAP would have your $400,000 home paid off. And your next door neighbor, who's not on the MAP, has only put $80,000 into the equity. And they still have 20 years to go. By the time they finished paying off their one home after 30 years, you theoretically could have purchased 2 more homes. This man is Patrick Henry. In 1775, the British told the Americans, you can keep your guns, but hand over your ammunition. Well, the Virginians at that time went to Patrick Henry and said, Patrick, if we don't give the British our ammunition, it would be declaring war on the Queen. What do we do? And Patrick Henry then said these famous words, give me liberty or give me death. Well, we believe that if Patrick Henry were alive today, he would say, give me liberté or give me death.